Welcome to our deep dive on mortgage freedom. Today we'll answer the big question many homeowners face near the end of their mortgage. Should you rush to pay it off or invest the extra cash instead? We'll move step by step, compare scenarios, and give you a practical framework you can use right away. Here's our roadmap. First, we'll clarify the core trade-off. Then, we'll explain why your interest rate is the critical factor. After that, we'll weigh pros and cons, discuss liquidity and emergency funds, and end with a balanced plan. Finally, we'll reinforce your understanding with 2 short quizzes. The central decision is whether to use extra cash to aggressively pay down your mortgage or to invest that cash elsewhere. Paying off the mortgage promises a guaranteed return equal to your interest rate. Investing aims for higher returns, but with risk and uncertainty. Your choice hinges on rate, risk tolerance, cash flow stability, and peace of mind. Before we go further, a quick disclaimer. This content is for educational purposes only and is not individualized financial advice. You should consult a qualified professional who understands your complete financial picture. Investing involves risk, and past performance does not guarantee future results. Here's the rule of thumb. If your mortgage rate is below 4%, the financial consensus often favors investing because long-term market returns have historically exceeded that low hurdle. If your rate is 7% or more, paying off the mortgage can be a strong choice because you are locking in a risk-free return equivalent to that high rate. The gray area is between 4 and 7%. In that range, the right decision depends on your risk tolerance, how steady your income is, whether you value certainty over potential upside, and your time horizon. Let's compare. Paying off early yields a guaranteed return equal to your mortgage rate, reduces monthly obligations, and provides psychological comfort. This is particularly helpful during economic uncertainty. On the other hand, investing may deliver higher long-term returns, preserves liquidity for emergencies, offers diversification, and still allows for a hybrid approach where you make modest extra principal payments while investing the rest. Liquidity comes first. Do not sacrifice your emergency fund to eliminate a mortgage. Maintain at least 3 to 6 months of essential expenses in accessible cash equivalents. Home repairs, medical bills, or employment changes can occur unexpectedly. If you are cash poor after paying off the mortgage, you could be forced to borrow at unfavorable rates later. Liquidity protects you from that scenario. This flowchart shows a practical path. First, check your mortgage interest rate. If it is below 4%, the likely recommendation is to invest the extra cash. If it is between 4 and 7%, pause and evaluate your risk tolerance, time horizon, job stability, and personal goals. Then consider a split approach that balances extra principal payments and investing. If it is 7% or more, paying off the mortgage often becomes compelling. Regardless of the path, maintain your emergency fund. Finally, review your amortization schedule and tax considerations before finalizing a plan. This table summarizes typical leanings. At around 2.8%, investing often makes sense because that hurdle is low relative to expected market returns. Around 4.9%, the decision becomes more personal and sensitive to your risk tolerance and goals. At 6.4%, the payoff case gets stronger because the risk-free return is more competitive. At 7.2% and above, paying off is commonly favored due to the high guaranteed return. Quiz time. The question is, if your fixed mortgage rate is 3.5% and your expected long-term market return is 7%, which approach is generally favored by consensus? The options are A. Rush to pay off the mortgage, B. Invest the extra cash, C. Empty your emergency fund to pay off now, or D. Stop investing entirely until the mortgage is gone. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Invest the extra cash. With a rate around 3.5%, you have a relatively low hurdle. Historically, market returns have often exceeded that level, making investing more attractive over long horizons, provided you maintain adequate liquidity and an emergency fund. Reviewing your amortization schedule is essential. Understand how much of your payment currently goes toward interest versus principal. In later years of a mortgage, a larger portion goes to principal, which means extra payments can directly reduce your remaining balance more efficiently. Use your lender's online tools or a spreadsheet model to visualize the impact of different payoff and investment strategies. Here is a balanced plan you can implement. First, secure your emergency fund with at least 3 to 6 months of expenses. Second, determine your mortgage rate bracket. Third, set a target split between investing and extra principal payments. As an example, you might choose 60% to investments and 40% to extra principal. Fourth, automate both streams to ensure consistency. Fifth, reassess annually as your rate, income, goals, and the market environment evolve. Sixth, avoid taking on new high-interest debt while you execute the plan. This pie chart illustrates a hypothetical monthly surplus allocation. Half goes to low-cost index funds, 30% targets extra mortgage principal, and 20% bolsters a cash buffer. This is just an example. You should tailor the percentages to your risk tolerance, time horizon, and mortgage rate. The key idea is to combine growth, debt reduction, and liquidity. Second quiz. The question is, what is the most critical rule regarding your emergency fund when considering early mortgage payoff? The options are: A. It's okay to use it if you will replenish later. B. Keep it intact, do not drain it for payoff. C. Use half for extra principal. Or D. Replace it with a credit card line. You may pause the video now to consider. We will discuss the answer in the next section. The correct answer is B. Keep your emergency fund intact. Liquidity is your safety net. Draining it to accelerate a payoff can backfire if an unexpected expense arises, forcing you to borrow at higher interest rates. This timeline compares two strategies over a decade. Path A emphasizes heavy extra principal payments in the first 5 years, eliminating the mortgage by year 5, and then investing the full surplus for years 6 through 10. Path B invests steadily for the entire 10-year period while making regular mortgage payments, with an option to add small extra principal payments. The timeline marks milestones, such as the mortgage-free date in Path A and portfolio growth checkpoints in Path B. Use this visualization to stress test your preferences and cash flow needs. Here are the key takeaways. 1. Your rate is the central factor. Below 4% often favors investing. 7% or higher often favors paying off. In between depends on your preferences. 2. Never sacrifice your emergency fund. 3. Peace of mind is a legitimate benefit. 4. A hybrid approach can deliver balance across growth, safety, and flexibility. 5. Review your amortization schedule and reassess your plan annually. To wrap up, let your mortgage rate guide the decision. Protect your liquidity and avoid taking on new high-interest debt. Customize a split that matches your risk tolerance and goals. Then automate your contributions, monitor progress, and adjust as your life and the market change. Thanks for watching. If this was helpful, please like the video, share it with a friend, and subscribe for more content on making smart money decisions. In the comments, tell us whether you are Team Payoff or Team Invest, and explain your reasoning. Your experiences can help others make better choices.